We're live. Welcome back to another episode of our Cubener series hosted by Ranchito Cube, where every month we dive into the minds of some of the brightest investors and entrepreneurs in our portfolio, shaping the future of tech. Today, we're thrilled to have not one, but two incredible guests with us, Sheel Mohnot and Marvin Liao. Sheel and Marvin, welcome to the show.
Thank you for having us. Great to be here.
And before we get started with all the questions that I have for you both, I wanted to briefly introduce you. So Sheel is a prominent venture capitalist and fintech entrepreneur. He's the co-founder and general partner of Better Tomorrow Ventures, a venture capital firm with a focus on pre-seed and seed stage fintech startups. Better Tomorrow Ventures portfolio includes successful investments in companies like Flexport, Mercury, and Hippo Insurance. And before launching his fund, Sheel built his expertise in fintech through various entrepreneurial ventures, in addition to his startup experience. Sheel spent several years as a partner at 500 Startups, where he led 500 Fintech, a sector-specific fund within the accelerator. And Marvin is a partner at Diaspora Ventures, a pre-seed fund backing European founders building tech companies in the US. He's also a partner and board member at Game Groove Capital, an international gaming holding company, and he was previously a partner at 500 Startups as well. And he has invested in over 414 pre-seed and seed stage startups like Aircall, ManyChat, Shippo, Ease, Printify, Embroker, Indio, and Backlot Cars. And prior to joining the startup world, Marvin actually spent 10 and a half years at Yahoo as an executive focused on expanding their business across Asia, Europe, Latin America, and the US. And today we'll be discussing everything from how to identify, how you guys identify winning startups to the current trends reshaping the future, the global startup ecosystem. And I want to remind everyone that we always leave the last 15 minutes of the sessions for your questions. So feel free to insert your questions in the chat, and then I will bring them up to the screen towards the end of the webinar. Marvin, Sheel, now let's get started with the questions. As you actually both know each other because you work together at 500 Startups, I would love to start by asking you if you could describe each other.
Yeah, sure. Maybe I'll get started. I thought about this. I had to think about this. We had worked together for a long time. So I would say, thing I say about Sheel, adventurous, fun, and argumentative. We used to have like incredible Slack discussions, which I actually really miss. And our investment committee conversations during the accelerator were always good. I always learned something. And super smart. Sheel doesn't make a lot of bad sort of calls or decisions, and he has really good judgment. I hate to say it. I actually think he's a better investor than I am. I actually hate to say it, but it's true. It's actually true.
I learned a lot from Marvin. When I came into 500, I really didn't know a lot about investing, and Marvin was like the guy who taught me a lot. Things I would say about Marvin. So he's extremely curious, just reads a lot, tries to learn a lot, does a good job of that. And then the interesting thing is, everybody, when they first meet Marvin, they think he hates them. He's like, all the companies at the beginning, they're like, man, they would always ask me, I don't think Marvin likes me. What am I doing wrong? And then by the end of the accelerator, everybody's like, oh, actually, Marvin loves us. He's just giving us tough love. And so that's what Marvin was known for.
I love to ask this question because you get much more of an insight of the person, especially when two people know each other and have worked together. Both of you, before becoming investors, actually had different careers. So Sheel, you were a consultant and then you became an entrepreneur. And Marvin, you were an executive at Yahoo. So I wanted to ask you the question, what made you become investors?
Yeah, sure. I'll let you go first.
Sure. Yeah. So after I was a consultant, I was a founder. And, at that time, I was living in Chicago. Startups weren't as big of a thing as they are today. And so I didn't know much about venture capital. And when I finally got to pitch venture capitalists, I looked at the other side of the table and I said, oh, that's what I want to be. You get to, what I thought was you're the smart one telling the founder what to do, predicting the future, all this stuff. Obviously, now I know that the founders are the smart ones, but I think that was my aha moment. This is what I want to do in my future. And then it took several years to get there, but thanks to 500 Startups, I got there. And then now, obviously, I've gone on to start my own fund.
Um, yeah, honestly, I was very accidental. So my experience prior to 2012 with VCs was actually not very positive. Thought like super arrogant, super cocky, thought they knew everything. And I would say sort of 500 startups was really helpful because, you know, I took 2 years off after Yahoo. And I basically just like angel invested and did a lot of boards and mentored at probably about a dozen different startup accelerators. And as I got to know folks like, for example, folks like Tim Chang and Mike Maples, Jr., like incredible people, I was like, oh, like VCs are actually really, really smart. Like they're always really, really smart, but just also like good, humble people. And then as I started doing the mentoring stuff, I was like, oh, this is actually really fun, right? Like just, and especially with the 500 crew at that time. And so, yeah, just kind of fell into it. It's like, wow, this is super fun. You get to work with like smart, like ambitious people. And you hopefully teach folks, but you also learn a lot too. So that was just like, wow, like, you know, as Sheel mentions, like, I'm very curious about stuff and you just learn so much actually working with startup founders. And so I think that's sort of what drew me in. And 500 Startups was one of the very few places that actually really valued sort of like sales and marketing experience. This is back in 2013, 2014. So that was a very unique sort of like place. I don't think I would have done well in a lot of other venture funds.
And why did you guys both decide to leave 500 Startups to start your own funds? And if you can also tell us maybe a little bit more about your own specific funds.
Yeah, I can get started. I mean, let's just say there was a bunch of management changes, and you know, I just think after a period of time where I was late to the entrepreneurial game and Sheel had done it before, so there is something about like controlling your own destiny and just also sort of like, you know, when you're in a partnership, you don't always agree on sort of like where stuff goes, and so there is something about controlling your own destiny. And so let's just say philosophical differences, and they kind of fired me nicely and my term, which was actually great, right? Which actually forced me to really rethink and going like, hey, what kind of life do I really want? And what kind of business and stuff do I really want to build? And that sort of led me to sort of where I am right now, which I'm overall quite happy about. And so I do think there's something about like running your, like most good investors eventually like leave to sort of like go and do their own thing because you're like, wait a minute, like I can build my own brand. I can kind of run this thing in the way that you want and follow a specific strategy that you want. So I mean, I think the sort of combination of all those.
Yeah, I think the same for me. I think things had really changed over there during the time that we were there. So there was a guy, Dave McClure, who started it, and he left in 2017. And you know, I think things changed during that time, and I think both of us kind of decided it didn't make sense for us to stay on going forward. And then I saw the opportunity to build my own fund, which I did with a partner, Jake, and it's been great, but definitely value all the relationships that I built during the time at 500.
Yeah. And we also hang out together, right? Like we have a specific sort of like WhatsApp group. So we all keep in touch and try to help each other out. So I love our alumni. It's incredible. Incredible.
It was a great group.
Yeah.
And can you guys share a little bit more about your respective funds? Because obviously you're investing in you're both pre-seed, seed stage investors, but you're investing in different things. Sheel, you're specifically investing in fintech. So if you can just elaborate a little bit more about your own fund.
Sure, I can start. So we're Better Tomorrow Ventures. We're a fintech-focused fund, leading pre-seed and seed rounds. And we're actually fintech and fintech adjacent. And when I say fintech adjacent, what I mean is there are a lot of other business models besides your core fintech companies that will ultimately derive most of the revenue from financial services. As an example, vertical SaaS. So if you look at like Toast or Shopify, 70 to 80% of the revenue comes from financial services. And we think that'll continue in the future. So we invest in those companies as well, vertical SaaS. And then the same is true of B2B marketplaces. Ultimately, a lot of the revenue comes from payments or from lending. So we like those businesses. And then between pre-seed and seed, we actually kind of differentiate them. Our pre-seed investing is done via a program we call the Mint. It's kind of like an accelerator. We bring companies in for 3 months and do a program similar to what we did at 500 Startups. And so that's actually like 1/3 of our capital, but more companies. And then 2/3 of our capital goes to sort of down the fairway seed investing, where we're investing an average of $2 million per check.
Yeah, and I'm a fan. I'm a tiny LP in their fund too, so I missed fund one, but a big fan of what they're doing. Yeah, so
Thank
from
you.
my side, yeah, I invest out of two vehicles. So I have a small rolling fund called Diaspora, and so it focuses on European pre-seed founders coming to the U.S. market. So it's very, very specific, and it's a generalist fund, so we do a bunch of like Web3, a lot of like developer tools and B2B SaaS, enterprise software, the standard stuff. I also invest out of a holding company structure. So I'm not part of Game Groove anymore. Unfortunately, the Russians invading Ukraine kind of ended that. So most of our staff was there. But I run another holding company where I invest out of. And so I do a lot more like defense tech and deep tech related stuff in that. And so it's like seed to basically whatever the hell I want. And I'm also an LP in about 8 different funds out of that.
And Marvin, actually, why European founders coming to the US? I'm quite curious about the decision.
It's very similar to sort of like Canada, right? Like Canada, I'm Canadian, so I do think there's an element of self-selection. Europe is incredible, great education, great educational system, but it's not necessarily. It's a fragmented market. Work ethic is kind of an issue for at least for startups, and I do think the U.S. is still the best market in general, like regulatory, entrepreneurial sort of like ecosystem, money, and so even exits as well too. So I do think there's an element of self-selection where it's like you're going to leave a pretty cushy life, to be frank, to come over to the US, and so there's just, and this is something we've seen. Like we looked at our portfolio back in, I think I mentioned this. We looked at our portfolio back in 2022. That time was like probably about 30 companies, and we're like, okay, the bunch of companies doing really well, a bunch of companies not doing so well, and a bunch of companies doing okay. Like, what was the universal thing of like all the companies that were doing well? It was like, oh, all the founders actually moved to the US. And that was universal. And so now, like after that point in time, we're like, oh, okay, so every company that we invest in the founders had to move to the US. And this is what we've seen. Like they just don't grow as quickly.
Yeah, no, I mean, with the podcast, I interview a lot of Italian founders, and a lot of them obviously start in Italy, and Europe is a really tough market.
Brutal.
Especially, it's brutal, but especially when you're from a country like Italy where it's big, but it's not like big enough. So you have all the small countries like Sweden or Lithuania that are building like these incredible companies because they're thinking European or global first because they have such a small home market. But like countries like Italy are tough because it's like 60 million people. It's still a lot of people, but it's not the US, obviously.
Yeah.
So
Totally.
Yeah, it is tricky. And why did you both decide to only focus on pre-seed, seed stage investments?
I really like it. I think
it's super fun.
It's just fun. I think the earlier you go in investing, the more it's about the founders and just building from the earliest stages. The later you go, it's all about spreadsheets and numbers, and it's more banker types who end up being the investors. And earlier, it's more founder types. And I think we both are more of that early founder mentality. Yeah. And so that's kind of why I do it.
Yeah, I mean, I totally agree with you. I mean, a big part of it is like figuring out the people piece, which is hard, right? Like just like trying to understand people. That part's tough. Is like, is this founder going to stick it out for the next like 7 to 10 years? And and I also think a big part of it is just sort of like you can have a disproportionate impact, hopefully positive on them and on the business, on the little small things. Where later stage, you're just like, I just think it's a very different impact and very different type of. It's just a very different type of investing, and surprisingly, I just think it's one of those areas where you're looking back with sort of, oh, is AI going to replace like VC? I'm like, yeah, maybe in the later stages. I think there's just so many weird things with people that this is just tougher to do because most of these companies pivot this early, right? So it's art, right? There's a lot more art than science.
Yeah. And like, obviously the founding team, the team is like the most important because if you have an A-star team, they can pivot, they can change idea and still build a great company. Lots of incredible companies have pivoted from the original idea. And so having sat across thousands of founders, what are some of the founder traits you look for? Maybe starting with Sheel so you guys don't overlap if there's a lag.
Yeah, sure. So for me, I think there are 2 things that are the most important. Number one is speed. So like how fast are you iterating and executing? I think if I look back at companies in our portfolio that didn't work out, in almost every case, it's just they weren't moving fast enough. So number one is speed, and then number two is tenacity. So are you willing to break through walls to make things happen? Like there will always be obstacles, there will always be difficulties that come in your way, but are you it's easy to give up when these obstacles come up, but the great founders will just break through walls to make stuff happen. And so I think those are the two traits that I look for most.
Yeah, I would double click on those. Those are great. The other thing I specifically look for is just a customer insight. Like, do they really know them? Like, have they done the homework? They could be from the industry, could not be from the industry, but you can tell sort of, this term everyone uses, like the idea maze, right? Where it's like they've clearly spent a lot of time sort of like thinking about this, and who knows, right? And having some strong view of the future. And the other things are learning machines, where just like, on top of everything that Sheel mentioned, just like they're just learning machines. So, right, like when they figure it out, where it's like, okay, this thing's not working, let's go find something else to do. But just like they're really, really good at like it. Just they have the customer insight, and just like they educate you, right? Like I actually think like a good meeting, when I and this is maybe 1 in 50 meetings that you do, you walk away with just like, oh, like that's really interesting, right? You learn something new. I'm not sure I'm not sure that happens in most of the startup founder meetings I meet. In some cases, I actually feel like I know more about the market, and that's a really bad. I mean, that's a really bad sign, right? Like it's a super bad sign when it's like, wait a minute, you don't know this about this market? Like, I like it when they challenge me, where it's like, I think I know something about the market and they convince me otherwise, where it's like, no, you're wrong. Here's what's happening. I'm like, oh, okay, that's a good meeting. That's a good meeting for me.
Yeah, like a unique insight into the problem that they're trying to solve. And what's a good piece of advice that you both find yourself giving founders most often, but that you feel is like ignored or often ignored?
No, well, that's a good question. So many.
I can go first.
Yeah,
there's so many, right?
So many.
I think it's easy for founders to chase shiny objects, which is like some opportunity came along, let me just go after it, rather than staying focused. So I think staying focused is one. And on that note, another piece of staying focused is not worrying too much about your competition. It's easy to like look at everything they do and try to do that, but I think it's better to just stay focused and avoid distractions.
Yeah, and I would say I would add on top of that, a big part of it is like focus on your customers, right? Like don't think about sort of like, well, how are investors going to look at this? I mean, who cares how investors like think about this, right? Like actually the big part is actually what do customers think, and actually spending way more time talking to customers and potential customers. Like they spend too much time like internal like navel gazing, or it's like, oh, how is this VC is going to, how are they going to interpret this thing? And I'm like, who cares how the VC thinks? Like you should care, but you shouldn't, right? Ultimately sort of what your customer thinks. And so yeah, that's probably spend a lot of time on that, of just the psychology of just sort of, oh, what are competitors doing, or like, oh, how is investor going to interpret this? And I'm like, yeah, it doesn't really matter.
Yeah, both are great tips, and definitely I've heard that before from different entrepreneurs. The ones that are really successful, they constantly talk to their customer. I was interviewing actually this year one of the early employees at Airbnb, and it was like a constant thing, right? Like just talking to their users, even when the company was massive.
Yeah.
And you both described each other, and obviously in a positive way when you were kind of talking about each other. But now, what do you think makes you a good investor? Good investors, sorry.
I mean, I could talk myself and tell you my view on Sheel. I think Sheel has actually like really good, I hate that term taste, but like it's very, very good taste and a very, very good read on product stuff, but also very, very good take on founders in ways that I still think I'm still trying to learn. And I also think that he has, particularly because he's an expert in fintech, that's why I'm a small LP in his fund. I think he has a very unique perspective on sort of like what's happening in the landscape, and very complicated landscape of finance and fintech, not just in the US, but actually global. That's my take. And he's been investing now for almost in this space for over like almost a decade, right? Like as an angel investor and whatnot. So he has actually a really good take, and he has a good, I think he has because he's invested in a bunch of really good companies and really good founders. And that's something I think I'm lucky because I've done a lot of deals of just sort of, you know what great looks like. And I think that's one of the challenges is just a lot of investors actually don't know what great looks like, what a great founder looks like.
I would actually say very similar for Marvin. I think like he's seen so many companies, over 400 through the years, has invested in a bunch of great ones, and just knows which founders are worth putting money into, just because he's seen it over the years.
Yeah, I will say,
And,
I will say one thing. I did screw up a lot in 2021 because I got very arrogant, and I thought I was like a much better investor than I was because of a bunch of exits and stuff in 2020. So I think a lot of us got, let's just say, a little bit cocky. So one of the examples, like one of the things I look for specific is like, how does this founder compare against my top 10 percentile of founders? And every time I've broken that rule, which I broke a lot in 2021, it's never worked out.
Yeah, I mean, I think we all made mistakes in 2021. Yeah. There's not a single person I know that didn't. Like, for me, I wish I had sold more during that time.
Oh my God, yeah.
it was a tricky one because selling, should have done. But for us, one challenge was our first checks we were pretty disciplined on, but then follow-ons like just came at these crazy prices.
So hard.
And it's a tricky situation. If you led the seed, are you not going to participate? If it's like a tier 1 fund leading a follow-on at a crazy price, it's hard to decide what to do.
Yeah.
And given there's so much, obviously we talked about the pre-seed and seed stage where so the founder is so important. So you have to have this connection, and it's not the metrics that you would look for in a growth fund. You're just looking at the business plan or the projections and the numbers. Like, is it something that you think is, if you're a good investor, it's because you're born with a good instinct, or is it something that you can learn to become a good investor? Because it's hard, like when you meet founders, they can also portray the most incredible thing, but then sometimes they might, be a total fraud. Like we've seen, Elizabeth Holmes with Terror. Like there's some that are really good at like, right? There's so many that are like really good talkers, but then there's no substance. Like, how do you, is there anything that's more like tangible that you kind of ask questions, like certain questions, certain things to try?
It's so tough because I think like, it's like that old joke, right? How do you sort of like have sort of like good judgment, right? It's sort of like through experience, right? But how do you get judgment? It's through like, just like really like bad experience, right? Like it's like, I think I'm wrecking that quote, but it's just like, how do you become a good investor? It's like through judgment, right? Like how do you get judgment from doing bad investments? I just think like I was an angel investor. I did 8 deals. They were all terrible. Like my first 80 deals at 500 startups, like I think 2 winners came out of that, right? So basically like 78 investments that honestly didn't really go anywhere that I probably should have been fired for. That's how you learn. Right? Like that's actually how you learn, by like doing bad investments and losing money. Unfortunately, I actually think it's a curse to actually have your first couple investments be good, whether it's in startups or stock picking. Like you start thinking you're smarter than you really are.
I love that. Sheel, do you have anything to add? Or...
No, I think I agree completely with Marvin. It's exactly spot on.
And as seasoned investors, and what's like a recent mistake that you both or you've made, and what did you learn from it?
I can start. I made so many mistakes. I think for me, one thing is sometimes you just get really enamored with an idea, and there's a difference between thesis-driven investing, which is like you have an idea and you want to invest behind it, and then there's opportunistic, where you kind of just find the best founders and invest in them. I think I tend to be more opportunistic, just find great founders and invest in them. But there have been times when I got excited about a particular idea and I just wanted to see that idea come to life. And then the first person who came along pitching me that idea, I invested, and it turned out to be the wrong founder. And so I think you can get into that trap if you have an idea that you really want to see. So that's one investing lesson. Don't try not to get in those traps.
Yeah, I mean the thesis versus are opportunistic, where it's like, I actually think like, I don't know if you've heard this like framework, Sheel. It's like the heat seeking versus truffle hunting, right? And so
Yeah.
it's just like, heat seeking, which like, oh, like, and I say a lot of times thesis driven, or it's like, that's a super hot deal and I need to find an allocation and fight your way in, versus like truffle hunting,
Yeah.
which is like, I'm going to go into sectors and spaces or look at founder types that are just like sort of like off the beaten track, right? Like not popular. And when I look back at sort of like the companies that have done well, that have either hopefully become real unicorns or have exited, like almost all of them have been like the truffle hunting, right? Like nobody wanted to
Mhm.
touch these spaces, or these are spaces that weren't super hot or unpopular. And so I'm just like, I look back on it when just like, wow, like I should be doing more truffle hunting, not this like sometimes I have to do the opportunistic, like, like the not opportunistic, like you have to do this thesis driven, heat seeking stuff. But I just think like that's something like if you're a brand name, you can play in that game. But ultimately where the returns come from are being opportunistic and doing the truffle hunting aspect. And so I do think it's a bit of both, where you should probably should have a thesis, but then, are you evaluating and looking enough sort of like deals in that sector to sort of like figure out who the best person to go after this opportunity is, right? And that's tough in this environment where stuff just moves relatively quickly in the hot deals. And so, yeah, it's super hard. This is super hard.
And how do you both like truffle hunt? Like, is it at like on LinkedIn or through connections or at events? Like, where do you find like the best talent, or these like startups that people are not on the radar of every big fund? Or
I travel a lot. That helps.
Yeah. Um, I think that helps. I think, some of it is outbound, some of it is just, in knowing enough other investors who send you quality deal flow.
Yeah.
Who, in my case, it might be a generalist investor who says, I'm looking at this fintech deal. I'd love your opinion on it. That sort of thing really helps.
Yeah. Yeah. It's a network. I get most of my deals actually sort of, as I would say, recommendations from other investors, either angel investor friends or VC friends. I go to conference just to understand sort of what's happening, right? And sort of get a set of sort of like the ecosystem. But in general, you don't necessarily find companies to invest in there. Most of the time, they're through introductions from people who know you well. And, my portfolio in the last 2 years have been mainly from that.
and what has been like your most successful investment? If you can talk us through a little bit that, like, did you like the story behind it, or how you found it, what the business was?
Yeah, shoot, you have a better track record than me, Sheel.
Yeah,
I'll let you go, man.
I can start with some old ones. Returned track record, and that would be Flexport. So Flexport is a company in the freight brokerage space, specifically mostly focused on cross-border between US and China. And I was a seed investor in the company in 2014, and then did a partial exit in 2021, 2022.
Oh, well done. Well done.
And it was like over 100x return.
Wow.
Actually, it was over 100x on the partial, so it was over 200x actually. The background, I met the founder just out in San Francisco. Like he was at some events I was at. I met him and just thought he was really sharp. And then he told me what he'd done in the past. He started a previous company called Import Genius, also in a related space, and he'd imported stuff from China before. So I thought he had the right chops to build this business, and it played out very well.
And what do you think made it such a good investment? Was it him? Was it the timing? Like, did you expect it to become
him.
Such an incredible? Yeah.
He's so smart. That dude's
smart.
I don't know him personally, but he's smart. Sharpest dude.
He's very sharp, and just like I said, fast and willing to break through walls to make stuff happen. And actually, so a little story. So last year, he brought in an executive to take over the company, Dave Clark from Amazon, and things weren't actually working out. So he stepped back in to the CEO role. And I think he was very quick to make that decision and say, hey, like, even though he'd been recruiting this guy from Amazon for several years, That guy from Amazon came in and started spending too much money, and so Ryan immediately said, "Okay, I need to go back in as CEO."
Yeah.
So I think it was a fast decision that really makes a big difference.
Yeah, I mean, the top founders have this like sense of urgency. I think, as Sheel says, it's like there's something not working. They fix it very quickly. They don't agonize over it, and they make a decision. They fix it very, very quickly. That's a universal thing of sort of like really the best founders. Like, yeah, it's just like they recognize something, they fix it, and they don't agonize over and like wait for three. Like, if your CTO is not working out, like fix it now, right? Don't wait for 2 weeks or a month, which is something you see all the time, and this is why most companies die, right?
Yeah.
I think for me, like I'm a big fan of like Matt Miller from Mbroker, and they're
Oh
doing
yeah.
very, very well, right? And so I remember looking, like we were intro to them, I was intro to them, and took the meeting, and I remember walking away. I had a colleague, and she's like, "Oh, they're so early." It was before insurance tech was very, very hot, but I'm like, "Yeah, but this dude's like really smart. Like he knows this market better than anybody else, and he's going to be quitting. Like he's going to be leaving like Hellman and Friedman, which is like a top private equity firm. Like he's getting paid $1 million a year. He's going to leave $1 million a year sort of like job to go and like start this thing. Like this is like massive I'd say conviction, right? And that's what you're looking, like I actually think like that's what you're looking for. There's so much opportunity cost that this person's taking, right? Like you're going to work on something for the next like 7-8 years where like that's almost a guaranteed $10 million you're leaving, right? And many of these founders are like, yeah, they could do much better working at like the Fangs or some other PE firm. And so that's a company I'm very, very proud of. They're doing very well.
And Sheel, why? Because obviously the focus is fintech and adjacent businesses, but what makes you so passionate about fintech?
Yeah, I think financial services overall is just a huge part of the economy. 20% of global GDP is financial services. And it's like a lot of it feels untouched by technology. And if I think about like on a daily basis, I'm annoyed at something or the other in my finances. So it feels like there's just a huge opportunity to make change. And then if you think about it from a people perspective, it's just a tremendous opportunity to make change in people's lives. And so I love that aspect of fintech.
And Sheel's too modest to say this, but prior to 500 too, he spent a lot of time helping out like Kiva, which is like a nonprofit. So a big part of big part of the mission of Better Tomorrow, right? Better Tomorrow Ventures. It's really about like financial inclusion, right? Like we take for granted being in the first world of just like, oh, monetary systems that actually work, right? Like money, like payment systems and basic things that just work, that enable your lives. And so like there's a reason they call it Better Tomorrow Ventures, right?
Yeah. Thank you.
Yeah. Mission, right? Like mission. It's a big part of it.
Exactly.
What you're looking for in founders, but also as an LP in funds, like you're looking for investors who are like doing this for like the right reason.
Yeah, the mission is, and it's like one of the most exciting things to be in the startup world, right? Most companies are trying to make our lives easier, a better world. So that must be like, it's a really exciting thing and empowering, and money especially, you can really change people's lives. And Marvin, you mentioned a little bit, you're sector agnostic, right? You invest in lots of different sectors, but you mentioned some of sectors that you're particularly looking at, like defense tech. Can you talk us through some of these hot sectors for you at the moment? Why are you looking at them? What are the opportunities that you're seeing?
I think part of it's personal and part of it's like just macro stuff. And so, obviously sort of like the why now. If you're trying to do defense tech, I never would have thought about doing defense tech prior to 2022. But the why now, because I was running a very significant business based out of Ukraine and Germany and LA. We had about 600 people working for us in Ukraine. So it's a gaming holding company. We had about 18 gaming companies. And so prior to the war, I'm like, you don't even think about this stuff. The world has changed so much on the sort of like a geopolitical level. And so the why now is basically the Russian invasion of Ukraine. And so think the world have changed. And then there's October 7th, right, with Israel, with what happened with Hamas in Israel. And I'm Taiwanese, so my parents are Taiwanese. So like all these things. And so, macro, America needs to reindustrialize, right? Because we realize like sort of the outsourcing of most of our manufacturing in China was kind of a mistake, and we're trying to fix it now. So that's a big part of it. So a lot of my thesis is around defense tech, militech, and it's all done out of the holding company, not out of the funds, because of just old LP stuff. And so right now I'm spending a lot of time, robotics. I think the AI revolution, yes, there's a software aspect of it, but a big part I think is going to be in the robotic space, and that's all tied to manufacturing. US is expected to double our industrial base over the next like 7 to 10 years. And so a lot of my investing is actually around that. So much more like deeper tech and a lot more like hardware related stuff, which is not something I've done like a lot of prior to 2022, 2023. So I've done now 3 defense tech related investments. I'm looking at a bunch of robotics and supply chain manufacturing stuff now. So that's my focus right now. And so there's macro stuff, but also personal, because the world's a very different place now. Unfortunately, this is not the world I want us to be in, but it is the world that we're in, right?
Yeah, it's crazy how many things we were living through in just like the last 4 years between COVID and now the wars, and it's expanding like and obviously it changes everything as well for business industries. And how has your perspective on investing in entrepreneurship evolved over the years? Is there something that you once believed firmly but you no longer do?
I can start. I mean, I used to do a lot of SaaS enterprise software stuff. I'm not touching that stuff now because I think, as Sheel mentioned, it just sort of like there, like particularly what Sheel mentioned about the later stage, where it's like, yeah, you can just like have analysts and formulas and stuff now. SaaS has become like that. And I also think what's happening with AI is changing a lot of how SaaS models are, where SaaS is almost too obvious, where if you talk to most VC funds in US, Canada, and Europe, 80-90% of them like, what do you do? Like, what are you investing in? It's like, oh, we do B2B SaaS and enterprise software, and just like run the other way. And that's actually quite tradition. I've done very, very well, right? Like I've actually had a lot of winners in the area, and now it just scares the crap out of me. It's too consensus and it's too obvious, and need to just go somewhere else because consensus is wrong.
Okay, I'll challenge that a little bit. So what I'll say is there's this notion that the only way to make money in venture is to be non-consensus and right. But actually, I think there's a tremendous amount of money to be made in just winning the deal. And if you look at, it's not like Facebook or Google were non-consensus bets. Every fund wanted to lead those rounds. Kleiner, Sequoia, all were angling to lead those rounds. Stripe, same thing. And what made those funds successful is they won those deals. And so we do think that there are opportunities in the non-consensus companies, but we also want to win our share of consensus companies.
I mean, there are reasons why stuff is non-consensus, right? So, hardware defense tech, they're hard. They're really hard, massively capital intensive in the beginning, and you may not even get the contracts, right? And then scaling's a complete nightmare. So like there are reasons why these are very, very difficult, like defense tech and manufacturing tech and robotics are really challenging. Or like I'd say deep tech in general is like really, really challenging. Like I do think sort of like if you build a brand and you have some point of view and you can get into the good companies, like consensus can make sense, right? Like for example of SaaS, where it's like why I moved away from SaaS, the consensus aspect, but also I just think the competitive aspect where I'm like, unless you're Jason Lemkin at SaaStr, right? Or you're Emergence Capital, where like you have the brands where you can literally get into those deals, that's a different story. And I'm like, I'm just so undifferentiated compared to like a lot of the other players out there now. And so I need to go look at like other sectors, which unfortunately defense tech is getting hot now too. But I do think it's a lot of generalists coming into this space, and I've always been interested in geopolitics, and I have a track record now of getting into a bunch of interesting companies where it's like, okay, I know what I'm doing, where I just think like I feel like I've slowly figured out my edge there. And I don't feel like I have an edge anymore in like SaaS and enterprise software and developer tools. At least that's just my take, right? But I would say in like you can be, you can agree and disagree at the same time, where it's like, I think Sheel's right about the fintech stuff. He has built himself an incredible brand. Like, dude, the stuff that he does on like Twitter, like you've built like an incredible, like Twitter's really hard. And I just think if you built a brand in a specific, both a personal brand and a firm brand, you can fight and get into good deals. And sometimes that is a strategy. You have to figure out the strategy that you have, let's just say, the edge in.
Yeah, absolutely.
I'm going to open up. We've got quite a few questions from the audience, so I'm going to start pulling them up. We have Andrea Cipriano for Sheel. What are the main red flags you look for during the due diligence process for early stage fintech companies?
There's so many. So I think, one that we talked about a little bit is founder just not knowing the space that well. Like they haven't done the homework. So, I expect that before a founder meets with me, they've spoken to a ton of customers. And a lot of times that hasn't happened. And I might point out something that a founder doesn't know. And if I know more than they do about their sector, that's a red flag.
And then we have a question from Francisco Matos for Sheel. How do you weigh the founder's ability to execute the go-to-market strategy for fintech startups at seed?
Go-to-market is super, super important. And actually, I think, it's hard to argue, but I think maybe more important than actually having the best product is having the best go-to-market. And so when I see a founder that has been able to has proven their ability to go to market, that goes a long way for me. And actually, we looked at a space where there were 3 different companies we looked at. One, the founder was great at go to market. One, the founder was great technically, and the third, I thought the founder might be great at partnerships. And the company that's winning in that space is the one who was great at go to market, just a killer salesperson.
Distribution, Peter Thiel talks about it, right? If you have a choice between distribution versus product, you always pick distribution.
Exactly.
Next question from Stefania Rossetti for both. Based on your experience, what common mistakes do international investors make when trying to enter the US market?
I think the mistake that they make is that they don't invest enough time. A once a year flyby meeting people doesn't get you what you need. We get that all the time, right, Sheel? How many folks do you know? How many international investors have you and I met, right?
Totally.
As LPs or VCs, where they'll fly in and then you don't see them for another year or sometimes never. And so we get this so often. We'll always take the meeting. But we don't take it seriously because they never come back. Most of them never come back. And so you have to invest the time. And right now, I don't know if you're seeing this, Sheel, there's a massive changeover in the venture landscape right now. There's a lot of funds shutting down. There's a lot of funds not raising or folks leaving to start new funds. And so this is a very, Silicon Valley particularly is a very dynamic ecosystem. So if you are not here on a regular basis, and I mean at least once a quarter, out here on a regular basis to sort of keep up the relationships and see what's happening. This entire venture landscape is just shifting right now. And so it's just, you'll if you're gone for a year, probably half the people you've met are gone or just doing something new. This is how dynamic it is. That's my take.
Yeah, I think the same. And I think actually it's interesting, people are going off of, some international investors still think about the world from 10 years ago, and they think about those things that are what make a company successful. They think Google having beanbags in their office and giving free food is what made them successful, And then when you talk to them about AI or self-driving cars, some people say, "Oh, that's so far away." Meanwhile, in San Francisco, I've been going everywhere in a self-driving car with no human in it for over a year and a half. So I think people just don't understand where the world is today. And it's like you said, because they haven't spent enough time here.
Yeah. I mean,
that's a great tip.
Yeah, it's the U.S. is, I would argue, Silicon Valley is probably about a year ahead of the rest of the U.S., maybe 2 years ahead of the rest of the U.S. and other ecosystems. And it's probably 3 to 4 years. I'm in Europe every month. I think it's about 3 or 4 years ahead of Europe. And this is an arrogance. It could be bleeding edge or cutting edge. You don't know, but it is some of the trends that you're seeing initially, it bleeds out. I'm from Canada too. It's 3-4 years ahead of where Canada is in regards to, and so it's hard to keep up.
Yeah, no, that's a great tip because a lot of obviously people who are listening in are investors. And again, in Europe also there's the UK is going to be very different from Italy, right? In terms of how late things, come to different countries. But definitely if you want to invest in the US, the take is to go more than once per year, at least twice, but better would be to go every quarter, as you mentioned. Question coming from Francesco Ghedini for both. How do you assess the solidity of a startup's cap table during fundraising rounds, and what key factors should be evaluated to ensure it remains favorable for both current and future investors?
I mean, screwed up cap tables is a curse coming out of Europe. So I'll give you an example. My best batch, performing batch 14, I took in 3 European startups. This is back in like 2015, right? So, but the story will exemplify what I mean. All 3 of their cap tables are screwed up. Like the investors own like 60%, 67% of the company. And we had to actually, I spent like months fixing a lot of this stuff. And it's just knowing what I knew right now. After that, it was a standard question like, "What? Show us your cap table," and because this is less of an issue in the U.S., I would argue, and so it's actually pretty important at seed stage, where a general rule, and I'm curious to Sheel's views on this one, where it's like, look, if they've raised money before at seed, you're probably giving like 25 to 30% of the company, and not really more than that. Because typically after Series A, it's like 50% of the company is owned by founders, because the path is so long, and so cap tables do really, really matter. Like I'm looking for ranges, right? Like where just like, look, the more the founders own, the better. But there are ranges. In general, you give up between 10 to 25% with every single round that you raise, as a general rule and principle.
Yeah, exactly. That's the way I think about it. And you see some of these incubators that own like 40% of the company.
Oh, so bad.
It just makes it uninvestable for me.
Uninvestable.
Because I know I'm going to have to top up the founder, and that's going to come out of my share. It's just too complicated to do the math on what that's going to mean and figure that out. So we just don't do it. So yeah, I think like Marvin said, realistically up to, even if you give up to 30 or 33% of the company in a round, that's okay in the early days. But any more than that, it's problematic.
So making sure that the founder has enough equity to stay motivated, I take from your answer, and then not having like a super early stage investor having taken maybe like half of the company away, especially an accelerator.
Actually, one more thing is also how the founders have split equity. So I've seen it where I've seen a few, things I didn't like here. I saw one where the co-founders had like a very unequal split, like 95-5, and the five was the CTO. And I was like, okay, I don't like this. I've seen another one. This is a company that got funded, by the way, a company where some advisor to the company was not full-time, had more equity than the CEO. So that was a big red flag.
Huge red flag. Oh my God, huge red flag.
And do you think it's a red flag
any
for the
advisor?
founders?
Really, sorry, just on advisors. I think advisors are mostly bullshit. Like they rarely add any value, and so they really should not have much stake in the company. And if you have a slide that's all about the board of advisors, like I just don't care about that.
Yeah. Oh, it's just, we hate that. I mean, it's the worst, right? It shows you that you have a crutch. And it's just like, I have no confidence in the core team. Look at my advisor, how awesome. It's just like, you think we're stupid. Like this, everyone uses that and it's not helpful.
Exactly.
This is an interesting one. I actually had never heard of this, but I understand your point of view. Do you think it's a red flag for founders to have like the same amount of equity in the business? Because if something comes up, like no one can really make a decision. Like, is that something that bothers you?
I've never seen it be an issue, actually.
Yeah, in general, it's not a big red flag for me in general.
Okay. Question from Gabriele Tessistro for both. Based on your experience now, how do you check on yourself to avoid falling in love, being biased when assessing a project? Any specific process you go through?
Well, great. I mean, Sheel, you have a partner, right? So you
for me, it's easy. We have a team, and there are times when I fall in love with something. And then Jake slaps me. It's like, yo, come on, man. You got to look past that, past this love. And then, it's been good for us because in some cases, it's gone both ways. And there are companies there's a company right now that he really likes that I'm saying, what are the follow-on prospects for this company? And so he's being more realistic about it, and it's making him rethink what price we offer that company.
Yeah, I think for me, there's two things. So with the Asper, I have a partner, Carlos, he's really good too, and so he counterbalances where I can still push. Like, I think for both of us, we can still push stuff through if you have enough conviction. But that questioning is helpful, right? Of just like having somebody look at it and just go, well, hey, have you thought about this? And sometimes you have blind spots, and so that's helpful. I think time. So one of the things I do now is I don't tell them if I'm in. I actually still write out a full deal memo, and just you go through the deal memo, and afterwards, sometimes that's actually helpful before I tell them I'm in or out, versus sort of writing the deal memo after you tell them. But just so you follow, it's just a small thing, right? But I do think the process of actually sitting down and writing this stuff out, and you're like, oh, this is, do I really? I don't have the conviction anymore, right? So I think having people you can trust, either co-investors or a partner or whatever, that can challenge you. And you can still do it, but that challenging is helpful to show if you really have conviction. And because I'm super lazy, like writing stuff out and actually getting stuff on paper was like, oh, like, yeah, you're right. This is an issue, right? And so that helps for me. And some time, like I try not to do stuff now, like decide in a week. Like I like to sort of like after the first meeting of, even if I'm in love, I like to give it a week where I'm just like, okay, like let's talk to other folks and see what else is out there. And just like then kind of let the love sort of like, I guess, give it time, right, to process.
And we have another question from Diego Dainese for Marvin. Do you think the current level of utility of generative AI is reaching a limit in terms of the real impact it can have on sectors such as fintech, SaaS, and digital health, and that a further technological breakthrough is needed to see a true revolution? Or will it be a linear progression of generative AI that will completely revolutionize these industries in the coming years?
Look, nobody really has a good answer in this one, but I'll tell you how I'm voting, right? I'm voting with my money. I think right now we're still in the early stage, and what Carletta Perez talks about, sort of like the installation phase. And so like the platform players are going to make the money here. I don't think the applications are there yet. In my opinion, I don't think we're there. And so a lot of this stuff actually reminds me of, I'm an old guy, so I've been here since like 99. A lot of this stuff, a lot of the pipes are being put in place. It reminds me of the railways, and actually reminds me a lot of like fiber optics and sort of like that initial sort of like Cisco and networking, where it's just like, this is all the infrastructure stuff. And so I think the applications will come later on. Like I think I'm super bullish on AI and super bullish on sort of where this is going to take us. But the big question, which is a mistake that most investors make, where it's like, is this 5 years from now? Is this 15 years from now? And I worry that we're probably 10 to 15 years from now and not like 5 years from now. But a lot of investors are investing like it's 5 years from now. So that terrifies me. And I think a lot of people, there's a lot of weird incentives in this market right now, where there's a lot of big funds that have a lot of money and they're investing, I'm going to say, not very soberly, but I think the incentives are against them investing soberly. So I think that's sort of distorting the market. And so that scares me. It actually terrifies me a little bit. So yes, it will have implications, but I think we're much further off than people think. Just my view. And I think there's better ways of playing AI. I think you might as well just invest in Microsoft and NVIDIA. I think that's actually a better play.
Well, thank you both. That was actually the last question from the audience. Thank you so much for taking the time to be here with us live, and then we'll also be publishing this on our podcast and YouTube channel, so everybody who missed it can re-listen to it. But thank you so much for all of your insights. I think it was definitely a really interesting conversation.
Thank you for having us.
Always fun.
Yeah,
thank you.
I miss a ham and egging with Sheel. We used to do this all the time. It's been years. We haven't done this for years.
Super fun. Yeah.
So thanks for bringing us together.
Thanks for bringing us together. Exactly.